Well, stocks have fallen 3 out of the past 4 days this week, but there may be some hope on the horizon. Stocks usually perform best in the third year of a presidential term. That, according to Ned Davis Research, and the fourth quarter of a president's second year, which is the quarter, of course, we're in right now, is even stronger. Joining us right now to talk about all of this is Tim Hayes. He's Chief Investment Strategist at Ned Davis Research. Great to have you here with us.
Thanks, Carol.
So talk a little bit more about history and election years and what we see in terms of the markets.
Well, the quarter that we're currently in has been the best quarter in the four-year cycle. And actually, the first quarter of next year and the second quarter next year are the second two best quarters. So really, we're in a
all 4 years in the average presidential term.
In all 4 years, it's the quarter that includes the midterm election and the next two quarters, which are the best. So you're in a 9-month window where the market tends to do pretty
So we're in a sweet spot right now, potentially, for the markets, historically.
Right. That's right.
It's interesting because the president's party doesn't typically do so well in the first midterm elections, right? Because it follows two of the worst quarters in the entire cycle.
Yeah, and what we found when we looked at what happens after the midterm election, if you have a sitting president, you have a president lose control in various scenarios, and it really turns out that in that first half of the next year, the market does pretty well regardless of what kind of makeup you have between the president and the Congress. So I do think we may have a little bit of a correction here over the next few weeks, but after that, things do look good.
Ned, what kind of a correction are you expecting?
I'd say something on the order of 3 to 5%. Basically, the market had been drifting higher, and we'd gotten some very overbought conditions, extreme optimism. A lot of good news has been priced in, the QE2 news, the election, the employment numbers. And then what typically happens oftentimes when you make a new high in the market, like the S&P did, you'll get a little bit above it, and oftentimes you don't stop right at that high, but you go a little beyond that, and then you can get into a corrective phase. And I think that's what we're vulnerable to seeing here over the next few weeks.
You also see some cyclical headwinds in the second half of 2011, and the bull run that we're on here is getting a little bit long in the tooth, right? That's
right. I think we've got, as you said, a good window here for the next few quarters. But I think there's the major factors we want to look at is not as much above and beyond the presidential cycles to think about things such as interest rates, which could very well start to rise by the middle of next year. Rising interest rates, we look for divergences within the market and increasingly narrow advance. What can happen is the rates can start to go up, and then you'll start to get the more rate-sensitive areas, rate-sensitive markets, conceivably emerging markets could start to look overdone, and by that point in time, and you could have a cyclical bear market.
Let me ask you, because you point out that interest rates could rise. We've seen this bull market go for so long. We've had a great September and October. There should be high optimism. You'd expect to see extremely high optimism when you look at the numbers so far, but we have a PE of 14.3 going forward. I mean, that's pretty low, right?
That's right. That's actually right in line with the historical norm, and that's one reason I think that's supportive of the next 9 months, and we can get a pretty good move up. And going into next year, we'll have to look for PEs around 20 or higher. That's where we got prior to the correction this year. Back in the first quarter, we got up to around 20, and that's when the correction started.
That would be an impressive feat, wouldn't it? I mean, getting back to 20 on...
That's right. That would be a really good rally.
Got 10 seconds left here. I mean, what would change your mind fundamentally? Is it Europe we have to watch for? What is it that worries you a little bit here? Just quickly.
Well, certainly Europe, if things would unwind. I don't think that's as big a risk, but certainly if we had an inflationary surprise, and that's something to think about next year in terms of a lot of the, we had the numbers out from China today, 4.4. That's still okay, but we can start to see signs of more inflationary pressures in the emerging economies, and that's something to keep in mind going forward.
All right, we'll do that. Tim, thank you so much.
Thanks a lot, Carol.
We appreciate it. Tim Hayes, Chief Investment Strategist over at Ned Davis Research.